Mm. Hello and welcome to Portfolio Matters. In today's podcast, Stuart Owen will be taking us through some potential inflation hedging investments. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The views of any guests we may have on the show are entirely their own and may not be representative of the views of Portfolio Matters. A full disclaimer can be found at the end.
Take it away, Stuart.
Right. Obviously inflation is in the news, so I thought I would draw together some ideas that I've had about inflation hedging. So this is obviously in the context of the inflation statistics that we're seeing around the world, over 6% inflation in the States, 5% in the UK, etc., driven by both monetary and fiscal stimulus. So, the foot is very much to the pedal from both governments and central banks, and it's having the effects that the textbooks would tell you. But the other aspect of this is that the go-to solution, i.e. buy index-linked bonds, is a very expensive solution. Index-linked have been bid up over the past few years, such that they're yielding -1% to -2% a year. So that may be bearable in the short term as a hedge, but over 5 to 10 years, you're locking in some very expensive losses. So with more risk, here are 4 different ideas that could give you a degree of inflation protection. These are ideas that I own in each case. So that I'm going to go through 4 different areas. The first is infrastructure investment trusts. The second is trusts that invest in green energy production, that is predominantly solar and wind. The third area is social housing. And the fourth is a subset of the real estate investment trust world, where there is particular reason to think that there's strong inflation hedging prospects. Now, the conclusion from this is that building a diversified portfolio, a quasi-index fund, as it were, across these 4 areas has got reasonable chance of giving you an immediate income of perhaps 4 to 6%, and with a sensible prospect of getting something like CPI growth in those dividends. So for me personally, I see these as, within my overall portfolio, a sort of replacement for bonds. I mean, I find it impossible to buy corporate bonds at sort of 2-3% yields, government bonds at even less, possibly even negative returns. So with more risk, these areas, these 4 areas, seem to me to offer a degree of bond-like return. So turning to the first area, that is infrastructure trusts. So there are various companies out there that own schools, prisons, roads, railways, pipelines, sewers, offshore transmission cables, doctor surgeries, etc. So what has happened is that governments, not wanting to pay for these things up front themselves, have got other people to build these facilities, and in return, the owners of those facilities receive payments from governments or local authorities or quasi-government institutions. Now, these revenues are largely, but not totally, availability-based revenues. That is, the facility just has to be open, the school has to be there, the hospital has to be open, etc. Though in some cases, the revenues are linked to demand for the asset. Now, the key thing here, which is why I'm talking about it, is that typically these contracts with the government have CPI linkages to the revenues that have been signed up for. Now, some of the investment trusts are more risky than others. Some do a bit of construction, and some have more demand-based or operating risks. So you do need to look through them individually to see the range of risk. But that's typically the sort of thing that they're doing. They're building infrastructure for a government and receiving a CPI-linked revenue in return for providing that asset. So here's an example of what I think of as the lowest risk of the lot, which is BBGI. And you can see a pretty steady progression in its net asset value, and also a pretty steady progression in its dividend. I mean, be careful to look at the scale there. The first dividend in 2012 was 5.5p. It's now reached 7p. So don't be looking for, sort of 10 baggers. That's not the pitch. The pitch is a modest and steadily growing income. Now that's BBGI, which is my favorite one. Favorite partly because it's got a low expense ratio and a big management ownership of the stock. But there are a couple of others that you can point to: INPP and HICL. There used to be a third one, John Lang Infrastructure Fund, but interestingly, a private equity company took it out because they thought it was worth more to them. Perhaps they were going to gear it up more than the public investment vehicle. So there's a hint of a possibility of other people finding these assets attractive. So steady net asset and dividend growth, reflecting those CPI links to the revenues. Looking through the accounts and analysis from the companies themselves, they see something like a 0.7 to 0.9 increase in their revenues for every 1% increase in inflation. So you're slightly lagging, but you've got a good proxy anyhow. The other thing to say is slightly mind your eye, because the net asset values of a lot of these trusts have risen as discount rates have fallen, because bond yields have fallen. So I can't pretend these things are cheap. These are hidey holes for capital preservation. They're not anything speculative which is going to double your money. So typically these companies at the moment are trading about 1.1 times their NAV and offer something like a 4.5% current income yield, hopefully rising a little bit each year.
Stuart, sorry, what's the name of BBGI?
Oh, it's unpronounceable to me.
Right, okay. But it's listed in London.
Yes, or there's three listed there: BBGI, INPP, and HICL. There's a fourth one, which is quite interesting, which is 3i, 3i's Infrastructure Fund, not to be confused with the 3i Venture Capital Trust company, but they do run a very different infrastructure approach where they buy assets, they put money in, they grow the business, they sell it on. So they are like a private equity version of an infrastructure fund, and they have performed extremely well. But it's a very different type of risk. It's in effect, it's a sort of private equity type bet, but I include it here because it focuses on infrastructure.
Right.
So turning to the second of the four, green energy trusts. So predominantly solar and wind farms. There's a little bit of anaerobic digestion and a few other bits and bobs, including emerging battery storage as well. But keeping it simple, focusing on the solar and wind farms, it's such a simple business model. Their revenues are 60% renewable obligation certificate subsidies. This is what's added into all of our electricity bills. And they've got an RPI escalation. RPI typically being a little bit above CPI, at least until the statisticians obey their masters and reduce that back down to CPI. So anyhow, 60% of revenues are government subsidies. 40% is the electricity price. And now typically the trusts will sign power purchase agreements with off-takers for 1 to 3 years. So there's a little bit of visibility and stability in their revenues. It has obviously been quite a good few months for them, in the sense that the electricity price has soared on the back of the gas price having gone up, which Portfolio Matters has covered quite a bit. But prior to that, there was actually the reverse risk which is that too many of these were being produced, too many of these solar and wind farms, which was leading to cannibalization risk. And there was a period of weakness in these trusts as people got worried that the electricity price was being fundamentally undermined. So watch out for that. Now, the fact that 60% of your revenues are coming from these renewable obligation certificates illustrates the key risk. If governments reneged on these contracts, so if you're interested in this, go in with your eyes open. That's the sort of thing that can happen. I believe it's something very similar to that did happen in Spain, and there have been other things at the edges of subsidy regimes which you didn't think that you were at risk of, but chipping away at some of these benefits. So if that's the revenues, on the cost side, well, running these things is very, very predictable after they've been constructed. There's a bit of maintenance, and that's about it. So revenues and costs are pretty predictable. There is, it should be said, a non-trivial amount of gearing in these trusts, because fundamentally the yields on which they trade are not that attractive. So to get the income out to equity holders, typically the trusts that are geared up around 40% of gross assets are typically representing the debt. You could see the debt possibly as an advantage if the debt is fixed rate, but the renewable obligation certificates are inflating by RPI. You could see a gradual wedge emerging between the revenues and the debt, leading to a bit better income and dividend growth if that plays out.
Just to come in on Spain, actually, what happened in Spain was they had a solar subsidy, and essentially it was far more popular than they expected. So they had far more solar farms were developed, so the subsidy was just much bigger than they had expected. So they retrospectively cut it.
So what sort of price are you being asked to pay, and what sort of income can you get from these things? Well, here I've shown again the dividend and the NAV progression for the granddaddy of this area, which is Greencoat UK Wind. UKW is the stock code. So again, you can see from 2014 a dividend of 6.25p, steady progression up to about 7.1p at the moment. And similarly, a nice gradual rise in the NAV of the trust as well. So these things have been going for about 7 to 8 years, and the NAV and dividend increases have come from that ROC indexation, the renewable obligation certificates, but also, as with the infrastructure trusts, lower fixed income rates have meant lower discount rates in the DCF calculation of the NAV of these trusts. So the NAVs have been inflated a bit by that. The electricity price itself will affect the NAV both up and down. And it should be highlighted that a couple of the trusts recently have been a little bit more cautious on what dividend growth investors should expect. Initially, everyone was gung-ho, this would be RPI increases, then that got trimmed a bit to CPI increases, and that's been trimmed in a couple of cases to a progressive dividend policy. Now, that all arose from the fact that electricity prices had a weak period and dividend cover began to fall. So typically buying these things at the moment, you're paying a little bit above the NAV, 1.05 times typically, and you're getting about a 6% current yield. So some of the stocks that are out there, Greencoat UK Wind, stock code UKW, Bluefield Solar, that's code BSIF, and you can see the other few listed on the slide there. There have been a range of other trusts launched as well, focusing on the States and on Europe. I'm less familiar with those and less familiar with the regulatory structure. Now, amongst these UK listed ones, you should also be aware there's a bit of geographic and technological variation. Some are wind, some are solar, some are both. Some are heavily exposed to Scotland, some have got a bid in Europe, etc. So as the disclaimer says, do your own research to find out more, but that's the overall picture. a pretty nice current income, hopefully growing, but mind your eye that there have been some cautious signs on the dividend growth. Turning to the third area, social housing trusts. So this is housing, but with a social purpose. So there are some trusts out there that provide housing for people with various disabilities, and also trusts that provide housing for homeless people. So the idea in particular in the housing for people with disabilities is that it's much cheaper for the government and better for the people involved if they're living in a sort of supported self-living environment rather than in a hospital or other institution, which is both expensive and arguably a more sort of hostile environment. So the trusts typically will repurpose existing buildings or increasingly construct new build, and they're leased out on fully repairing and insuring CPI-linked leases. So that's the inflation linking, the CPI aspect to the leases. Now, one thing to be very aware of, and which hasn't got too much coverage, which I think will soon, is the fact that these leases typically have a cap and collar in the contract, where the annual increase is capped and collared between 1% and 4% per annum. So 10% inflation, and you're going to be capped out. You're going to not catch up with that rate of inflation. So the underlying revenues, they are these CPI-linked leases, and they're leases with housing associations who are in effect acting as sort of pass-through agents for housing benefit. Now, this whole area has been quite volatile despite the underlying stability of the assets, because there have been a series of regulatory investigations of the housing associations. Basically, the concern is the housing associations are signing up to onerous leases. Having said that, every time there's been an investigation, the result has been more that the housing associations have had to tighten up their governance guidelines, tighten up their recruitment of finance directors, etc. But the underlying economics of the lease model hasn't been challenged yet, or hasn't been overturned. But do mind your eye. And at the moment, this is actually the cheapest area amongst the four inflation-linked trusts that I'm speaking about today, because a couple of weeks ago, there was another one of these investigations coordinated with a short selling attack on one of the providers. So the leading provider of social housing, Civitas Social Housing, is, if you're prepared to take a bit of a punt, by far the cheapest opportunity across the four areas that I'm talking about at the moment. I'd also highlight, similarly to I was speaking about before about the green trusts, I think there's a bit of a debt wedge here, that the fixed rate, long-term fixed rate debt versus growing revenues could be a nice plus in the future. Normally, I think of debt as something to be avoided, but in a high inflation environment, you could see in effect an inflating away of that debt. So again, looking at the individual stocks and what sort of price you're being asked to pay and what you're getting, they haven't been running as long as the green trusts, which themselves haven't been running as long as the infrastructure trusts. These social housing investments have been going for around 2 to 4 years. So there's a couple involved in adapted living for handicapped people. That's Civitas Social Housing, that's CSH stock code. And, oh goodness, I've forgotten their real name. I just always call them Soho, SOHO. Very, very similar companies. There's one focused on homelessness, code HOME, H-O-M-E. And there's one focused on affordable rent. This is prefab houses put up and then let on much more affordable rentals. So there's no aspect of looking after disadvantaged people. This is just cheap social rents. That's the private rented sector REIT, PRSR. Now, all of them have had about 100% occupancy of their properties. COVID hasn't affected them at all. They offer around a 6% yield, and similar to the other funds we've been talking about, but with a shorter track record, they've both shown net asset value and dividend progression. The chart here I'm showing is of Civitas Social Housing, the stock I mentioned before, and this is, if you're looking for a shorter term opportunity, this is the one to look at, where the stock has fallen well below NAV due to a short seller attack, plus an ongoing fear of regulatory intervention. Now, when you look at the share price charts of many of these trusts and across all four of the sectors I'm talking about today, you'll typically not see anything too startling, but that's because you're looking at the capital share price. You've always got to remember that underlying that, you're getting 4 to 6% a year in dividends. So there's an upward slope to your total return. And now the fourth sector is a slight grab bag of REITs, that is real estate investment trusts, but they've got a binding logic, which is they've signed CPI or RPI linked contractual leases. So this is corporate, not credit, not government credit risk, if you think about it like that. The previous ones have all been in effect government risk, either housing benefit or renewable obligation certificates of what have you. But here you're getting companies, you're getting REITs which are making CPI linked leases to regular corporates. So you've got a corporate counterparty, not a government counterparty. Again, they have fixed rate debt, often very long term, 15, 20, 25 years in some cases. And a small point, these are best held in tax exempt accounts because of the taxation of property income distributions. In effect, it means that you can receive a gross dividend and not a net one. So it's slightly complicated. Have a look around on the internet if you're interested, but it means that the level of income is appreciably higher if you hold it in an ISA or a SIPP. So there's three clusters within this selected group of real estate investment trusts. The first is warehouses, and this is pretty simple, simple to understand. The growth of online shopping needs huge warehouses. There aren't enough of them, and companies like Tritax Big Box or Tritax Eurobox offer exactly the sort of modern warehouse, high spec, high ceilings, often with solar panels, etc. And they'll sign inflation-linked contracts with, for instance, Amazon or a supermarket or a sort of building supply company, that sort of thing. The second cluster is student housing. And so this is not strictly CPI linked, but historically, until COVID, they were increasing their fees, particularly to international students, each year by CPI or RPI. And a bit like I was speaking about for one of the infrastructure trusts, there used to be a few more of these, but they've been gradually taken out by private equity companies looking to gear up regular, predictable earnings streams. So Empiric Student Property and Unite Group offer this sort of exposure. And then there's a set of specialist real estate investment trusts that I'd highlight. One is called LXI REIT, and the other is Custodian REIT. And again, they offer exposure to CPI-linked leases to care homes, coffee shops, supermarkets, hotels, etc. So that's your underlying risk. And just to highlight what can happen, LXI REIT had, I think, about 15% of its portfolio in hotels, and 2/3 of that 15% was let to Travelodge, which was owned by a private equity company who absolutely stiffed them and just said, yeah, I know I've signed an RPI linked contract, but I'm not going to pay. What are you going to do? So they claimed force majeure because of COVID. And the funds were forced to accept a couple of years of much reduced income. There was a lot of press coverage of it at the time, and it was the lesser of two evils to suck it up. So you have got corporate credit risk here, not government credit risk. what can you hope for here? A bit lower income than the other three areas that I've been speaking about, 3 to 5% immediate dividend yield, and a bit more variability in the dividend progression, though that's mostly due to what we hope is at least a short-term impact of COVID. Most of these you're having to pay a premium to NAV, 5 to 10% premium. And again, you should be aware that NAV itself, it has been boosted by yield compression, i.e. lower interest rates, lower discount rates means higher NAVs. So you're paying a premium to already somewhat inflated NAVs, but you're getting hopefully a long-term store of value via these RPI, CPI linked contracts. Also, as ever, there's a degree of gearing in these trusts. Often, well, it varies, to be honest. Maximum around 40%. Some are much lower, around 20%. So, to try to wrap up, there's no perfect inflation hedges out there. The ones which should be the perfect hedge, inflation-linked bonds, you have to pay up for, locking in real-term losses. I see a portfolio of these trusts as giving immediate income plus steady dividend growth. So I see them as a sort of higher risk version of an index-linked bond. The prices are usually above NAVs, and NAVs that have already been squeezed up by lower discount rates. There is a risk, particularly in the green energy case, of retrospective legislation. There's a degree of debt, which you could see more as a benefit and not as a risk if it gets inflated away. And underlying all of this is the idea that you really must do your own research to be clear what sort of risk you're taking on here. It's a risk that I'm happy to take via a diversified portfolio across all four areas. I see that as offering a store of value, a return of capital, as it were, in an area where, or in an era of the risk of high inflation. So this is a hidey hole to preserve capital.
Great, thank you, Stuart. So essentially, these are like index-linked bonds. In the case of, let's say, the REITs, you're getting 4.5% with, and that 4.5% should increase with CPI. Essentially, but whereas index-linked gilts are currently yielding -2% real.
Yes, exactly. In return for taking some sort of extra risk, either corporate risk or retrospective legislation risk.
Yeah. The ones that seem to be the safest, the ones that are linked to essentially government guarantees. So you either got green energy or social housing. So there's no corporate default risk. The only question is, are they going to retrospectively change the rules? And that in the UK, I think that's fairly unlikely, isn't it? What do you think the risks are with the government-backed ones? Because the yield, compared to the yield on index-linked gilts, there would seem to be a very serious yield uplift for these. So they might seem a much better investment.
Yes, well, there is some operational risk. As COVID hit, some of the operators of various facilities suddenly realized that they had a bigger bill to run and to change some of the facilities. So it's similar to an index-linked bond, but there are the operating risks that go along with it, either because it's a demand-based revenue stream. So if you own a toll road and the traffic forecast is completely wrong because COVID means no one's traveling, you have got risk like that. But overall, I think it's a risk worth taking, a big diversified portfolio across this area, particularly as time and again I've seen the share prices sort of weaken on some news or some fear, but then they bounce back 3, 4, 5 months later. You're made whole. So, which is why I was highlighting Civitas Social Housing as that immediate opportunity, where it's been attacked by a short seller and another fear of the regulator.
Effectively, you are vulnerable to the same vicissitudes of the market, aren't you? Interest rates go up, your net asset value is going to drop. The economy goes into, you have difficulty in the economy, and there may be fears that the operational risks increase, and that may affect the share price. And if you have inflation, then the value ascribed to the income will fall. But that's no different to the risks that are anywhere in the market. But it appears that there's much less volatility, and there's a far lower risk of your investment in any particular one of these going bust as a consequence of economic problems, I would think. So you're effectively sort of stabilizing your portfolio to the extent that you contain a portfolio or a subsection of these within your portfolio.
Yeah, absolutely. That's how I look at them, as sort of very probable but not definite stores of value. And in a world where equities are rated so highly and bonds so highly, I can't argue these things are cheap, but I do see them as a store of value.
And in each category, you own several of the trusts that you referred to in the talk. Is that right, Stuart?
Yeah, absolutely. Yeah. I think, as I was mentioning at the drinks last night, I'm trying to create a sort of index fund of this type of thing. If there was an ETF of them, I might buy that, but I own the individual ones. That's right.
Yeah. Interesting.
So I think the risk you have with certainly the corporate ones and the ones which have an RPI link is that their input inflation is higher than CPI, and then their margins get squeezed. So if you have wage inflation go higher than CPI, and bearing in mind historically, if you look at service price inflation, it's been very much higher than CPI, and that's been offset by essentially negative manufacturing goods inflation. And if that continues, then actually you could see margins progressively squeezed because wages outstrip inflation.
Yes, that's a good structural point, isn't it? That ultimately the people who've signed these leases might get very squeezed and might look for a way out.
Yeah, they have little pricing power, don't they? Because effectively the prices they can charge are dictated by government.
Exactly. That their price is explicitly linked to RPI. That's what they're going to get. And if their costs rise more than RPI, they're in trouble. But right, we are running out of Zoom time. So I think we're going to wrap it up there. Thank you very much, Stuart, for giving us some serious investments, which are, not the usual spivvy stuff we cover on this channel. But anyway, if any of you wish to be sensible, you might want to follow Stuart's strategy. So anyway, thank you very much, Stuart. And I hope you enjoyed that and press like and subscribe to our channel. And in the meantime, it's goodbye from all of us. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.